Okay, g'day, Rudy here. So in this video it's all about the American share market, and we'll go through what's gold telling us about it, what's interest rates telling us about it, and what the Aussie dollar USD is telling us about it. Jam-packed. Alright, so this is the S&P 500 weekly chart. So you can see we're at the top of the channel. I did say unless these support lines are broken, there's nothing to worry about it. So it's now up and away. So what's been the large driver of that? Well, this thing here. So this is US 1-year yields. So we all know the Fed's now just forgetting about inflation. It's only concerned about unemployment, so it's just going to drop rates. My opinion is there's probably in a recession, and Fed's just going to drop rates as low as they can. It's going to cause a lot of inflation. Then they'll just it's like trying to revive an addict, just give him more hits until he dies. So for now, that's why the share market's running. And so once this breaks here, then it will be party time, and party time for gold too. Okay, so that's one big driver. Now, so that's the good news. Now this is the bad news. So what we're looking at here is, so I just changed it to a monthly chart of gold over the S&P 500. Okay, so what are you doing that for, Rudy? Okay, so actually let me take that away first so you can see. So as I said, so gold over the S&P 500. So when it's going up, gold is outperforming that index that we just looked at. And you can see now we've broken the down wedge, so we're going for another up signal. Okay, now I'll go back to, what are you telling me that for, Rudy? Okay, so if we go back in history, okay, so remember this, the green squiggles is the chart we were just looking at, gold over S&P. So you can see when, so down here, so it broke, this is when the trend went up, and so this is the S&P 500, the purple line. So when it went up, the share market went down. Okay, so same here, when it broke up, the share market went down. Then we come back, and then obviously, and then it's sort of an inverse thing. So then S&P beat gold and the share market went up. Okay, so now we can see, so here we broke up and the share market went down. Here we broke up and the share market went down. Now here we went up, just this bit here, and it went down. So now we're breaking out again. Now I don't think the share market's going to go down because of that interest rate, but my call, just my opinion, is when this gets up to approaching, when this gets up here, I reckon that'll be the top of the share market. You heard it here first. So I don't think the share market's going to crash, although if you listen to everyone on YouTube, they say it's top, it's overvalued, recession, blah blah. There's too much juice in the system, but I reckon this is the signal to watch, because then I do think it will happen, because I think gold's going to go up faster. So until it breaks, starts getting more consistent, I reckon we're okay, but yeah, that's just a theory. The rooster told me that theory. Okay, so so they'll look at what's under. So what's driving the? There's three parts of the American share market. There's your XLK, so that's your technology, Apple, Microsoft, Nvidia. So bang, they're up above the top channel, so that's probably going to run. So the XLK over the S&P 500. So it's back to adding value. It was detracting value from the S&P during these weeks. So it's now back to adding value. The second biggest sector is the XLF, which is your financial sector. So it's on the top of this big trend line, holding this squeeze, which, as you know, rising wedges are bearish if broken. So it would, given momentum's up, it would have to be a pretty significant red bar to break it. So at this stage, you can't call it. So XLF, so the financials over the S&P 500. So this is the bar here. So it did nothing. It didn't add or detract. The week before was a big detractor. So that's neutral. And then the other big sector is the XLC, which is the communications. So it's your Google, Meta, Netflix. So that's already up and broken this one, and now it's heading for the next trend line. So that's up. So that index over the S&P 500. So that's been adding. So obviously, as we all know, it's this market and the global market is just driven by big tech. A couple of other sectors which aren't big drivers but just interesting. The XLE, which is the energy sector. So this is your Woodsides of the world over in America. It's your Chevrons, Exxons. So that's basically consolidating, and my view is biased to the upside. And XLV, which is the healthcare index, which is just going sideways, and I don't really have a strong view on it because I don't know enough about it, but they're not big contributors to the S&P 500. Then there's the NASDAQ, the actual NASDAQ index. So these are the levels that had to break, didn't go anywhere near them, so they're back on drug time. A health check for the NASDAQ is the semiconductors over the NASDAQ. So that's done that consolidation at highs and bang. So that's your NVIDIAs and that's all your semiconductors. So that's signaling that the NASDAQ party game is on. Okay. So now to the Aussie dollar. So monthly chart. So really since 2012, this hasn't been an issue for people investing in America, because as it comes down, the value of your investment's gone up. Oh yeah. Yeah. So if we look at the response, so if the S&P 500 goes up 10% and the Aussie dollar goes up 10%, the results are in. So 68%, so more than half, said 0, which is correct. And we had a few people say 20%. I get it, you just add 10 and 10. And then I threw the 9 and 11 in because they were taking 10% off or 10% on the 10%. So congratulations to those who said 0. Now it's not. It's complicated. I get it, but I've got a little formula. Get rid of that first. So this is if you want to know the formula. Okay, I should. Oh, that's a bit too big. Sorry. Let me go down. Okay, so how do you work it out? So this is it. So you go 1 plus y over 1 plus x, take 1. All right, that's so y is your US dollar return. So say that was 20%, then you'd say 1.2. And x is the Aussie dollar US dollar increase rate. So if the Aussie dollar went up 10%, you'd put 1.1. Okay, so in the case of that one, so if So if IVV, so if any share market US went up 20% and the Aussie dollar went up 10%, the result would be 9%. And then in the case of the example, so the share market went up 10% and the Aussie dollar went up 10%, so that means 0. But that hasn't been an issue because it's just the exact opposite has been working in reverse. So as the Aussie dollar went down, the denominator got smaller. So you're getting a bigger return than someone in America. But we're now starting to potentially worry about that kind of stuff because the Aussie dollar, if we're moving into a commodity cycle, countries like Australia and Canada, our currencies tend to outperform. So we've started doing that. So now you need to start wondering what you do with your overseas holdings. You can buy hedged versions of them, but I just wanted to make that point that if you didn't realise that, like if you're in IVV, so that's IVV, you can see how that's basically at the same price there, whereas if we look at the S&P 500, it's gone up, and that's because IVV is that return has been pulled back by the increasing Aussie dollar rate. So that's that. If the Aussie dollar goes up, it's bad, basically. So then we go on to VGS. So it's the same thing with VGS is basically 75% America, and then you got Japan and UK. So all those interest rates impact on it, but it's the US dollar that is the one, because these are US dollar based ETFs that you have to worry about. So from a chart wise, they still look fine. VGS, your VGS over VAS. So for those people, so VGS has been, you haven't wanted to be invested in VAS, you want to have all your money in VGS, you would have made 60% more since 2015. But there are other options to look at. Like if we benchmark the King, so MVR over VGS, so this is our resource ETF, you can see it started outperforming VGS, and I reckon it will continue to. And one of them, this is one of the ninjas, I call them, this is basically on the ASX, so this is your gold miners ETF, and you can see it's clearly outperformed VGS. If we look at from here to here, it's 100% more than what VGS has done over the last 2 years. So there's other things you can look at, but there are also hedge versions. If we go and look at the Nasdaq, well, we're here. So these are the NDQs. So again, just sitting at the top. Your FANG sitting at the top, but these are all impacted by the Aussie dollar. IOO. So technically they still look good, and if the Aussie dollar doesn't rise up, then you could be fine. Qual. So same thing, just hanging there. And Moat. Moat's disappointing. It's a Morningstar one. Value hasn't been a good place to invest in. It's all been about momentum. All right, so I want to go through. So think about how the Aussie dollar is going to impact your overseas investments, and there are I think there are hedged versions of those. I can't find them anyway. And then you got keep an eye on this gold over S&P 500. As I said, I think once gold surpasses this ratio, I reckon that'll be the top. And just keep hoping the Fed keeps dropping interest rates, and that'll keep this thing going. All right, let us know your thoughts. See ya.